Good evening, ladies and gentlemen, and I do thank you for tuning in to tonight's broadcast. We will cover the action in the precious metals. It is the 9th of August 2017, and this is Christopher Aaron, and we will focus on the reasons why I am still cautious in gold and silver. We will look at the historical examples in detail in this video. So let's get right into it. Now, looking at the past 3 days in gold and silver, the price action has been very encouraging when we simply look at gold and silver themselves. So gold once again flirting with a breakout, registering a breakout to be precise, but we've seen these false breakouts on so many occasions over that declining long-term trend line over the last year to 15 months that we really have to make sure that gold is being decisive here. And this is my reason for caution. We'll get into it in a moment. Looking at silver, nice price action for silver. And I just want to remind you, as we get into some of the negative divergence signals that I am looking at here, this is coming to you from someone who owns a significant amount of precious metals and precious metals miners. However, I don't sell the metals themselves, and I have never been someone who is going to be encouraging you to only buy, because we have seen over the last 5-6 years that that type of rhetoric can really destroy long-term wealth accumulation. We have seen that. So I come from this from a standpoint of, what do? I share research. I share the best research that I am capable of producing. Sometimes that is going to signal that I think the metals are moving higher, and sometimes it is going to signal that there is reason for caution. So that's the business I am. You can agree or disagree with the research, but I just want you to know where I'm coming from here. So we are talking about the negative divergence that is continuing to exist between the gold mining equities and the price of gold itself. And we will look at the current example coming up. We looked at it last week. And mind you, if you haven't gone back and watched the video from 2 weeks ago, the video from 2 weeks ago shows the example of the one time in a mid-cycle consolidation, such as we are in right now. We are not at a long-term top, and we are not at a long-term bottom. That's what I mean by mid-cycle consolidation. The long-term bottom thus far was in late 2015. So we are in a mid-cycle consolidation. The one time that I have found in my study of history, and I've poured through these charts for 20, 30 hours over the last couple months looking for these historical examples. The one time that I have found in which this signal that we are going to be looking at today has proven false, the one time that I have found was in 2003 to 2005. And we talk about that 2 weeks ago, in the video from 2 weeks ago. So if you want to know what I'm referring to with the one time that this signal was incorrect, please go back and watch that video from 2 weeks ago. Hit pause right now. Go watch that one and come back. Getting into the current action, I want to show you some of the ramifications for when we have observed this signal and why I am still cautious even right now. So let's go back in time to 2001, 2002. We are talking about gold on the bottom of this chart in the HUI Gold Miners Index. This is a basket of about 20 gold mining companies. We are talking about the price action of these two plotted along the exact same time just one right on top of the other. Now, just as a little backdrop, I know a lot of people are really turned off by the gold miners, or they're just sick of them. And I understand that rhetoric. I've been there before. I do think there's a lot of potential in them in the future. It may not be quite yet. It may be. But I understand the rhetoric. But even if you have no interest in the gold mining sector, and you are only going to invest in the physical metal, or you're only going to trade futures, let's say, I still think you should pay attention to what is happening in the gold mining sector because of the historical accuracy of the correlation between the two. So let's look at it. HUI on top, gold on the bottom. And what are we specifically referring to? Going into 2002, when gold prices were in the low 300s per ounce, let's look at the rise in gold from June 2002 through February of 2003. We're talking about the rise here from 330 to 385. And we are seeing in the HUI Gold Miners Index at this exact same time, no rise. This is negative divergence. So mind you, negative divergence doesn't have to mean that the gold miners are moving down. Negative divergence can be that the miners are simply moving sideways as the price of gold is rising. In a normal bull market, the average gold miner, assuming they're a well-capitalized company that's already producing, the average gold miner will rise 2 to 3 times the percentage increase in price of gold. So as opposed to rising 2 or 3 times this 20% rise right here, we had no rise whatsoever. That is negative divergence. And what was the result of this historical time period, this negative divergence from 2001 to 2003? We are talking about here the miners correctly negating this entire rise in gold and seeing the entire advance given right back over the next several months. In percentage terms, now, I mean, it looks, when we're using dollar values here, it's $385 down to $320, plus or minus a couple bucks here. But we are talking 16.5% in percentage terms. So you have to translate this into today's dollars. If we were to see a 16.5% drop in today's dollars from $12.75 gold, we'd be looking at 1,058 within a couple months. So here's the negative divergence. Here's what happened 2001 to 2003. Let's look at another example. We're looking at 2007 to 2008. Look at the rise here in the HUI, the second rise, nominal rises 5.4% and 7.2% here, going from late 2007 into 2008. Amidst an 8%, 8.9%, and 12.8% rise in gold itself to the peak at $1,033 an ounce. This coincided with the depths of the Bear Stearns crisis, the Lehman Brothers crisis, in the subprime debacle of 2007, 2008. Anyway, negative divergence once again, right? The miners are supposed to leverage 2 to 3 times the gains in gold, and they actually had only a fraction of the gains in gold. Negative divergence led to the crash of 2008. And you could say, well, the crash of 2008, mind you, which resulted in a 30% drop in the price of gold from the peak, 30% drop from $12.75 of today would be $892 in today's prices. And you could argue that, well, this was the crash of 2008. This was a special circumstance. We're not looking at a crash right now. Maybe we are, maybe we're not. But the point is still coming into a crash, way before the crash began, actually, here. The gold miners were already telegraphing this negative divergence, this relative weakness here. They were already saying, no, this is not going to last right now in gold, at least over the intermediate time frame. It took gold a year and a half to get back and exceed this level. So there is the second significant legitimate example of this negative divergence. Let's look at one more example, longer term lead up here. We're looking at these nominal rises in the HUI Gold Miners Index. This is 2010, very end of 2010 up through 2015. Nominal rises in the HUI, 2.5% and 2.2% amidst what? These massive 10 and 23% rises in the price of gold itself. I mean, this was, in retrospect, and this is where I cut my teeth, as well as in the crash of 2008. So you could say I was twice bitten and a few times shy, but such is life. And I've learned my lesson, and that is why I do not ignore these signals. You may ignore these signals if you want to, and this may be the time where these signals are not accurate. We have shown that one example. But I do not ignore these negative divergence signals, because when they happen like this, amidst such a clear rise in the price of gold and such a nominal or failing rise in the gold miners, of course, this led to the final 2011 top and almost a 5-year bear market. 45% drop in the price of gold. Of course, most of the mining companies getting decimated over this time. So, the summary on mid-cycle gold consolidations. 2003, 2008, and 2011. A notable negative divergence developing over multiple months led to a significant gold top. 2005, this is the video from 2 weeks ago, a negative divergence, the one time in which the miners were fooled, and then everything advanced. So the miners just got it wrong, gold started to advance, and then the miners played catch up and eventually leveraged those gains in gold. So we see 1 out of 4, and we're talking the significant gold peaks here. This we could dial this in, and I've even done this for trading purposes sometimes, to dial this in into intra-week, even intra-day. This is a fascinating ratio to pay attention to if you're so inclined to really dive into the hour-by-hour price action. But as far as the significant mid-cycle gold consolidations, there are 75% odds that the miners are correct based on the historical precedent. And where are we today? Let's update the current chart. GDX on top, GLD, the gold proxy fund on bottom. 1, 2, 3, 4 very clear lower peaks amidst a gold price that has made 1 higher peak, 2 higher peaks, and this one is still a lower peak, although it's flirting with the former highs from 1295 amidst the lower peaks here in the gold miners. So will this fit into the 25% of time that the miners are incorrect? It could be. Listen, from the standpoint of my own portfolio, from the standpoint of what would be good for business, as far as when do people become interested in things, of course, it's when the prices rise. So I, in some way, would love for this to be one of these times, and it could be. But all I'm saying is to be prudent. If you are highly leveraged in this sector, if you are choosing to ignore signals like this, you're betting on odds that are not in your favor. So These are the kinds of things that we look at week in and week out in the research service that comes out. We are doing more subscriber-only premium videos that are of this format, but longer, covering everything, covering the precious metals. They're about an hour in length. I'll be working my way up to having those out every week. Right now we're doing about 2 a month. We cover physical gold, silver, the GDX, and everything that's going on in the technical action of the gold and silver sector right now. I also work with individuals from across the spectrum, from beginning stackers who just don't want to get taken advantage of because dealerships try to sell you semi-numismatic coins for a 30 or 40% premium, all the way to advanced traders who are investing millions of dollars. So I do thank you for tuning in. If you would like someone to offer an independent perspective on your situation, I'm happy to do that for you. Thanks again, and I will see you this time next week. It should be an exciting week as we see, is this signal going to be correct or not? It is very, very tight at this point. I predict that by this time next week, we are going to know whether or not the miners have been fooled, or whether or not gold is ready to exert itself and carry the entire sector higher.